So now you already have a basic understanding of how to navigate the market. But to trade effectively, we need to dive into two crucial concepts: liquidity and volatility. Liquidity is the ability to quickly turn your assets into cash at the price close to the market value. The faster this happens, the higher the liquidity. Think of money as water and assets as containers. The easier and faster the water flows from one container to another, the higher the liquidity. This concept applies to many areas: assets, company balance sheets, banks, and businesses. There are three main types of liquidity: high liquidity assets, cash, stocks, bonds, currencies, and government securities. This can be sold quickly and easily, almost instantly, without much loss in value. Medium liquidity assets, for example, accounts receivable, people who owe you money, or goods ready for sale. They can usually be returned into cash within 1 to 6 months. And finally, low liquidity assets, things like old equipment, overdue debts, or real estate. Sell them is slow, difficult, and often requires lowering the price to find the buyer. In the market is the same story. Some stocks are highly liquid, others are not. So how do you know if an asset is liquid? Look at this trading volume, how often is being bought and sold. Highly liquid stocks have huge trading volume. You can buy or sell them easily without causing big price swings. For traders, these are goldmine. Low volatility stocks trade rarely. When big orders come in, they can push the price up or down sharply. If you don't want unnecessary risk, avoid entering large position in such assets. To check this in practice, traders use the order book, which shows the number of buy and sell orders to each price level. And yes, this time order book isn't just a metaphor, but an actual trading tool that we'll dive into upcoming lessons. Volatility shows how much the price of an asset, whether it's a currency or commodity or anything else, change over time. Think of it as the amplitude of price swings. The bigger the difference between the highest and lowest price in a given period, the higher the volatility, guys. So if the price moves slowly and steadily, volatility is low, like a calm sea. If price jumps up and down, like a roller coaster, volatility is high. By watching volatility, you can gauge how exciting or risky an asset is for trading at the moment. And that brings us to the end of this lesson. In the next lesson, we'll leave the curtain on who really controls the market and reveals the trader's hidden advantage over the so-called guardians of liquidity, the market makers. But remember this: the more you practice and analyze, the more confident you become as a trader.